So you're ready to start investing, but you don't quite know what you should be invested in. Should it be individual stocks, bonds, index funds, or ETFs? All of which are great ways to invest, but in this video, I'm going to simplify it for you. Stay tuned. So if building your portfolio is like building a house, your account is the house itself. When I say account, that means whether you're investing through Vanguard, Fidelity, Charles Schwab, Webull, Robinhood, whatever. All of those individual platforms acts as the house itself. The features you want to include in your house, let's say a fireplace, a garage, an eat-in kitchen, those are your target asset mix. The specific finishes you choose, well, those are your investments. So here's a quick look at 4 very common investment products. But before we do so, for those of you who are new to this channel, welcome to Let's Talk Finances. My name is Trey. I'm a Special Operations Forces member, and I am here to help you get out of debt, reach financial independence so that you can begin building wealth. If you're interested in this, please don't hesitate to subscribe to this channel and smash the like button if you would. I would really appreciate it. What exactly is an investment product? An investment product gives you access to a single asset class or a combination of asset classes. An individual stock or bond exposes you to a single asset class, stocks or bonds respectively, while a single ETF or mutual fund can expose you to one or more asset classes. So investment product number 1, individual stocks. An individual stock is traded on a major exchange like the Nasdaq. You essentially own a piece of the single company that you are invested in. Number 2, and that would be individual bonds. So this is one that I think a lot of people get confused with. Like they hear of the term bonds, but don't know exactly what it is. Well, I've got you covered. When you purchase a bond, you're lending money to the bond issuer, whether that be government agency, or corporation. And in doing so, you're exchanging for repayment with interest, all right? Let's say you're purchasing a bond and you're lending money to a government entity, all right? This government entity has to pay that back plus interest. Now, in this particular instance, a bond is great to add security to your portfolio because let's say you're invested in individual stocks or some of these other products that we're going to be talking about. It can be very, very volatile. And in order to smooth that ride out, you would like to add some bonds to your portfolio. Now, the general rule of thumb would be it's best to add bonds the closer that you get to retirement, and it would make sense, right? So the further you are from retirement, the more aggressively you can invest. To whereas the closer you are, you want to dial back on your level of aggressiveness and you want to start investing conservatively. And the way to do so is by adding bonds. Product number 3, and that would be exchange traded funds or ETFs. So an ETF bundles together many stocks and bonds in a single investment, and it also trades on many major exchanges. Now, again, an often asked question is, hey, what's the difference between an index fund and an ETF? I've made another video that hits this on the head as well. You can watch it right here. An exchange traded fund is essentially the same thing as an index fund. The only difference would be, I would say, 2 categories. The first one is how or when you can trade it, all right? So an exchange traded fund, as I previously stated, can be traded like a regular stock, all right? And the second thing is when you go to buy or sell that exchange traded fund, the price that you see is the active and most current up-to-date price. Investment product number 4, and that's going to be a mutual fund. A mutual fund, like an ETF, bundles together stocks, bonds, or securities in a single investment and tracks that index. When I say index, I'm talking about a benchmark. And for those of you who aren't familiar with that, that index or benchmark could be one like the S&P 500, which is one of the most, or if not the most popular index that a lot of funds try or attempt to track. Another difference between an ETF and a mutual fund, an ETF when traded goes from investor to investor, to whereas a mutual fund is typically purchased and traded by companies or large corporations. An index fund is actually a type of mutual fund. Mutual funds can be actively or passively managed, but in this particular instance, the index funds that we're referring to are more or less generally passively managed. In a nutshell, you have 4 investment products: individual stocks, individual bonds, ETFs, and mutual funds. Now, let's go over what to consider when trying to make the determination between these particular investment products. So one of the main things that I generally tell people to take into consideration when you're looking at a specific investment product is the cost. Cost matters when you're investing. The less money you spend, the more you keep. The cost of an investment depends primarily on its expense ratio and commission. So let's break down these 2 particular ways that investments can cost you. Number 1, expense ratio. An expense ratio is pretty much the percentage of a fund's total assets that go toward the cost of running the fund. Just remember, when you're looking at that expense ratio, the lower it is, the better it will be for you. Let me give you an example. If you invest $1,000 in an ETF or a mutual fund with a 0.10% expense ratio, you'll pay $1 a year in fees. However, if you invest the same amount in the same fund with an expense ratio at 0.60%, you'll pay $6 a year. Now, remember, all of these are relatively low. However, $1 a year and $6 a year can accumulate very rapidly over a course of long period of time. The lower you can make your expense ratios, the better it will be for you in the long run, especially in retirement when you're trying to build a very comfortable nest egg. So remember, the lower you can make that expense ratio, the better for you. Now, let's go into the second avenue of which cost can be a determining factor: commissions. A commission is a fee you pay to a broker each time you buy or sell one or more of a stock, bond, or ETF. If you buy shares of 20 individual stocks, you'll be subject to a $20 commission charge. If each commission is $5, that's $100. Regardless of the total amount you invest. Similar to an expense ratio, when you pay less in commissions, you have more money available to you to compound. So ETFs and mutual funds are more likely to have an expense ratio, individual stocks, individual bonds, and some ETFs can have a commission. If you're looking for some really good ETFs to go ahead and start investing with, in this video, I have some suggestions for you, so be sure to check that out after this one. So now that we have cost out of the way, let's go into the second factor that you should be considering when you're looking to invest, and that would be your investment style. So an investment style describes a technique used to pursue a goal. Some investment products, including mutual funds and ETFs, can be active or passive. So let's go over these 2 particular methods of investing. Number 1, actively managed accounts. Generally, actively managed accounts seek to outperform the market to generate above average returns. Just remember, in outperforming the market, you will tend to see higher returns. However, it is very difficult to outperform the market. You do have some actively managed funds that can and have done so with extensive research, time, and effort. Just remember, actively managed funds, the higher the volatility, the higher the risk, also higher returns. Investment style number 2, and that would be passively managed funds. So a passively managed funds, or in other circles which are known as index funds, they're known generally to hold bonds or stocks in the index it tracks. Remember, with index or a benchmark, just think of one like the S&P 500. The key thing about a passively managed fund is that it seeks to mirror, not beat the market, all right? It seeks to mirror. The good thing about the fact that it seeks to mirror it is you're gonna average about between 10 to 13% returns. However, it is very much so less volatile. So with less volatility, you reap more benefits with less loss, all right? And that is something that is very important when you're talking about investing. There you have it with that, the two particular investment styles that you want to take into consideration when investing. If you want a more detailed breakdown between actively and passively managed accounts, in this video I actually went over that, so be sure to check that one out after this one. So now that we've broken down those investment styles, the third thing that you should be taking into consideration is convenience. If you're like most investors, the amount of time and effort you want to spend building a diversified portfolio may be the most important factor in choosing an investment product. Here are some questions that you should ask yourself, and the answer can very well dictate which product may be best for you. The first question, do you want to individually select all of the stocks, bonds, or securities that you choose to invest in? If the answer is yes, then individual stocks and bonds may be the correct choice for you. However, if the answer is no, do you wish to make automatic withdrawals and investments? If the answer is yes, you may want to consider mutual funds. However, if the answer to that question is no, do you want a complete portfolio in an all-in-one fund? If yes, then you should consider mutual funds. Do you currently have $1,000 or more to invest? If no, then you should consider ETFs. The reason being, there's no minimum amount for you to start investing in it. However, if the answer to that is yes, do you want to know the price of that particular fund the moment you go to invest in it? If the answer is yes, you should consider ETFs. If the answer is no, you should invest in mutual funds. So once you've chosen an investment product, select a specific investment with an objective that matches your own. Whether you choose a single investment or several investments to hold in your portfolio, the total percentage of stocks, bonds, and cash that you own should match your asset allocations. If you're still wondering, hey, what's the best index funds that I should be invested in? If you're invested through Vanguard, in this video, I actually went over that, so be sure to watch that video after this one. However, if you are a Fidelity investor and you also want to know what are the best index funds that you should be investing in, I also went over that in this video, so be sure to check that one out after this one. There you have it in a nutshell, guys. If you've ever asked yourself, hey, I want to invest, but which one should I be investing in? Individual stock, bonds, mutual funds, or ETFs? In this video, I've covered that. If you found this video to be helpful in any way, please go ahead and subscribe to this channel, as it helps me continue making videos just like this one. And in addition, don't forget to smash the like button for the YouTube algorithm. I would greatly appreciate it. Until the next video, guys, let's talk finances then.